Good morning, ladies and gentlemen. Well, the big news this week is that the model went to risk off. Now, the score is still positive. You will say, how is it possible for the model to go in risk off during a positive score? Well, that is because the model works on moving averages, and even if the score is positive, the short term score could fall below the long-term moving average. So one moving average, the fast one, falls below the long-term one. And that is precisely what's happened. Now, we have had several periods of risk off when the score was positive and actually remained positive. And these are these periods, notably in 2010, and then in 2012, and finally in 2014, when the score remained, when the model rather remained in risk off for very long times, but eventually these three all proved to be false readings. What is important to understand, though, is not so much that they proved to be false. They proved to be false after many months, but in the meantime, the market always made new lows. In this case, in 2010, made a new low by about 7%. In 2012, it made a new low by about 0.25%. And in 2014, it made a new low by about 2.5%. So it does say something. It says that even if the market in the longer term it will go up, the likelihood that we have seen the low is very low. But rather than concentrating on why the stock market might make new lows, it's important to understand why what is happening is happening. It's not geopolitics, although that doesn't help, it's rates. So if we are pricing out most of what we were pricing in throughout this period, it's natural that multiples should contract. Now, then the question becomes, where are rates likely to top out? I think at the moment it's extremely unlikely that the Fed goes from promising 3 cuts in 2024, followed by another 3 cuts in 2025, that we go straight into a hiking cycle. And indeed, the data just does not support that. There's no inflation acceleration, there's inflation stubbornness. There might come inflation acceleration after the stubbornness, but that is going to take quite a few weeks. The data doesn't come out for a long time, and therefore I don't think the market can anticipate it. What the market will do probably is test something like the level around here at 507 in the twos, and I still think that if you discount what the Fed has promised and take away 75% of it, you still get at zero funding around the 507, 509 area, and I think the market is unlikely to break that. I will be a buyer of twos, as I keep on telling you, around that 507 area, and the area I like least is actually the 5-year area, because I think R star is rising, and therefore the curve will have some sort of positive funding embedded into it, because there's just so much issuance out there. And where is the issuance? It's at the belly of the curve. So every time the fives dip, I think that is the area that you need to concentrate on to look for higher levels. And I think that when the 2 years are trading 507, the 5 years will be trading up here at 486. To me, the 5-year has nowhere to go but higher. What I'm less bullish about or bearish about is the 10s and 30s, and the 30s is the interesting one. I think the 30s will be trading not much higher than here, around the 485 area, when the 2s and 5s reach their targets. So the curve, I think, is going to do a hump. And let's have a look at what that looks like. Twos, fives, they got to the level that I wanted to sell. Did I sell it? No. But you can see the direction of twos, fives. And then if you look at fives, thirties, you will see a completely different picture. This is one that is going up. That is telling me that the twos, yes, they're going to go another 6-7 basis points. The 30s, yes, they're going to go another 6-7-8 basis points, but the one that's going to go the most is going to be the area of the belly, which is between 5s, 7s, and 10s, and those could go up to somewhere around here in the 530s, which tells you that the curve, to me, is going to kink. So this is the current futures curve. Obviously, disregard this is wrong. But what is interesting to me is this. I think that this belly needs to go out and basically be on top of twos. Now, why? Well, if we believe that R star is rising, that means that the terminal rate is going to be higher than we supposed earlier. So if the Fed is going to start cutting rates later, and if the Fed is going to have a higher terminal rate for the cutting cycle than we anticipated, and the Treasury is going to be issuing net 550 billion in coupons for as long as the eye can see, then why would you buy something with negative funding? The only way you're going to buy that is if you have positive funding. So let's assume that we have a cutting cycle that goes no lower than the fours. We can argue whether it's 4, 4.25, 4.5. We can argue until the cows come home. But why would you want to be buying a 5-year note which almost guarantees you that you will not see much positive funding throughout that period? I think the risk reward of owning fives is absolutely dreadful. To me, fives and twos should be trading very much closer together, because if the cutting happens, it's going to happen in the next, let's call it, year, right? And therefore, you're at some stage, if you're buying the 5-year note at a futures yield of, say, 520, around there where I want to buy, that's the futures yield, not the cash yield, you are almost guaranteed to have positive funding for at least a year. While in the fives, you're just not guaranteed to have any positive funding the maturity of the tenor. Therefore, I think that the fives, and to a lesser extent the tens, are the most vulnerable part of the curve. And that is all there is to it, that every time the fives rally, you're supposed to sell them. And here is the twos, fives, 30s butterfly. So you're long 1 twos, you're short 2 fives, you're long 1 30s. This could go a long way if it starts breaking here, couldn't it? It could easily go down here in a day, and that is a long way. And if we look at the twos, fives, tens, it's got the same kind of picture. This is not healthy. It could go, around here. So we will be watching these levels like hawks. I've got them marked. I've got the alarms set, and I'll be tweeting to you when we break and how far we're going to go. Germany cannot withstand the backup in US rates by itself, and this is the Schatz. These are the kind of levels you're looking for now. You're looking for 310, 311, and that is where you want to get long again. The bobble is the one that I probably like least, and now we're looking at 264. And the Bund, it's still not breaking the 251, 252, but I reckon it could easily go to 257 next week, where it's probably a better buy than not. Germany is just following the US, and the one that tells me that it's probably going to break, higher in yield is the OAT, which just could not hold the previous highs. It's breaking out, so we're likely to see this 313 area. The OAT trades technically much better than the Bund, so this 313 area to me is favored, but those are a buy simply because the differentials are still going out, and let's have a look at those. So here you have the twos, and I would actually leave this one well alone because the negative funding in the Schatz is just too much for the time being. People are just not sure that the ECB can go without the Fed. I think they can, but for the time being, that's the one that's least attractive. I think the most attractive is still the tens, because this one just will not stay below the previous highs. It went to 210, which was our objective, very, very quickly. And then, of course, it retraced because it got there too fast, but it's still in an uptrend. And I still think that you are more likely than not to reach these kinds of levels around the 230 area within time, and I'm talking several weeks, not days, simply because there is just so much issuance in the States. So I'm always a better buyer of bunds. If I'm bullish, on a day that I'm bullish, I'll buy the bunds, and on a day that I'm bearish, I'll sell the 10-year. I still think that this is continuing out. 5s actually is probably interesting insofar as it confirms my view that there's a lot of reticence in buying the short end in Germany, simply because it has discounted so much relative to where the current funding is, and they're saying, oh my God, what if we're in the same situation as the States? And therefore people are very reticent to buy it. I think the ECB will go first, and I think they will go before the Fed. But it just slows down any kind of enthusiasm for buying the Bobble and the Schatz in Germany. I still think that this one will go to at least 231, and that tells me that if I allow for 5 basis points in Bobble, I have to allow for quite a bit more in the 5-year note, and that basically confirms to me that the 5-year note is the area that you should concentrate your shorts in. Well, last week the Dixie did exactly what I thought it would do. It got to this 106.25 area and slightly more, and then it backed off, and it's now consolidating and waiting. Where would I think it has support? I think it has support around this 105.5 area, and if it trades, it's probably a very good opportunity to get long of it. There's little doubt in my mind that we will do something like this, that we will consolidate here before the FOMC and the QRA, which happened the week after this one. And if that is, how shall I put it, if the QRA shows a lot of coupons, then we will have a breakout in yields. Those differentials against Germany will go out, and the Dixie will have an opportunity to strengthen. And then I think that we trade these levels, 107.12, 107.20. And if you look at this is the long-term moving averages, and everything is now going to be supportive around these areas. And then we can start breaking higher over the course of the summer. I think there's very little doubt that the dollar is going to be stronger than the euro over the course of the summer. You can see that these moving averages, 200-day and so on, are all turning lower. So any kind of move back up to 107.20, 107.30 puts spread time, isn't it? Well, what about the euro against the Japanese yen? It's still not time. It's not giving us any technical signals that it's time. I think it's much more likely to break up and then reverse badly. But I think that what one has to do is wait for the yen to exhaust against the dollar. And I think that, as Brent wrote in that note, around the 156 area is likely to be it. So I would much rather wait for that than not waiting for 156 to give me probably a signal that there's going to be intervention on the yen, and then the euro yen from new highs around 166 marginal, stopping everyone out, will probably finally give us a signal. What will the signal be? Well, the first signal is going to be a weekly close below this 162.50 area. As soon as that happens, you should be looking for a test of around the 160, the 200-day moving average, and then some consolidation, then finally a breakdown. That is what you're looking for. At the moment, you're not getting it. The moving averages are all still pointing up, but you're looking for a trend reversal. And the trend reversal, as I showed you last week, makes sense because of the differentials between the euro and the JGBs. Those are going to be coming in over time, and that is why one has to be looking for a reversal at some point. But that point will be when the technicals say it's there. I can't make it happen before then. There are just no sellers of gold at the moment. I think that's more the problem than anything else. And you just, you can't go against it. It's as simple as that. Where would I like to buy it? I would like to see a retracement to at least this kind of level, if not 2300. I just don't know how gold can keep on defying real rates, but it can, obviously, because it's doing it. And it's doing it because it's such a small market. I just don't see the point of anyone who doesn't have to buy gold for them to do it. And if you own gold, these are the best levels you have seen in your lifetime to sell it against buying tips and getting a real return over CPI. That having been said, it doesn't look to me like it's exhausted. These are all green candles, so every week it's closing higher, and basically we need to see some kind of a wick, something like here, where it was trying to go higher and it failed, and there were sellers. Here there are just no sellers for the time being. Could it be geopolitical on top of everything? Yeah, it could be, but I just think the simple answer is that it's a very small market, and if 1, 2, 3 central banks come in and they buy everything that's available, how's the price going to go down? I think it's probably that simple. Doesn't make a difference that I've been wrong for a long time, but that is what it is. And oil, well, what to say about it? I think it's scared of the release from the strategic reserve that the administration promised if it starts spiking, and it's therefore going sideways. It would take something extraordinary for it to start breaking the highs. I think it's much more likely to remain in this range than not. It's going to take a while and a very, very good reason for it to break higher. I'm not that bullish on it. I don't think it can really make it by itself, not for a very long time. So I don't think DBC is going to be breaking higher anytime soon. And I think, in fact, DBC and oil are the ones to be avoided. Here we have DBC. and I'm completely wrong about the relationship to oil. Sorry, to gold. It's definitely going higher. DBC, I think the likelihood is that we trade lower actually and fill this gap a bit. And then, at around this 2288 area, it's probably not a bad area or slightly lower to start getting long of it again over time. But I mean, just dipping one's toe, I don't think it's imminent. I think this is a weekly chart, don't forget. I think it's going to take a couple of months, even longer, for this to base around here and to be in a position to start breaking out. It's not going to be a short-term affair, it doesn't seem to me. I think we're coming into an interesting period in equities, and that is because I think that realized volatility is going to be higher. Let me explain that. I think that we're getting to very oversold levels, but yet we have not seen a decent bottom. I think we could easily see days of 100 up, followed by days of 100 down. What I mean by that is that we are very, very oversold. We can get more oversold without a question. But this, we are, where is the bottom likely to be? We have filled some gaps, but there are still some gaps remaining. It's quite likely that the real bottom is somewhere just short of the 0.382, which is 48.20, because it'd be too easy if that was the low. But what I'm expecting the next few days is basically violent retracements to this 50-60 area, and then violent moves that stop everybody out below this low and then back up. Now, the markets love going into the FOMC and the QRA very close to an important moving average. And I would argue that in 10 trading days or whatever, no, it's less, 5 plus, say 7, 8 trading days, we will be trading very close to this red moving average, wherever that might be. I think that we are going to be not very far away from here in terms of where we are, but we will have gone up and down, and I think that implied volatility might be lower than realized volatility, and therefore everything I do in the next 10 days is going to be through options rather than through outrights. I think that is going to pay much more than not, and I think that calls are going to be always too cheap, because when the squeeze comes, it's going to be fast and furious, and calls, especially 2-day calls, 3-day calls, are going to be far too cheap. So equities, in inverted commas, last week did not have a very bad week. This is the weekly chart of the Dow, DIA, the ETF, same thing, and you can see that it actually closed exactly where it opened. It was unchanged. What really changed was basically the Nasdaq, and this is the chart of SPY over QQQ. This relationship is beginning to turn, and you can tell from these, the way it's trading. It might just consolidate for a week or two, but I would not be surprised for it to go another, 5-6% easy. So the problem is not so much equities as it is actually tech sector. And why would that be? Well, we have the QRA and we have the FOMC, and I think the tech sector, being very high beta, is actually afraid that we are not going to see any cuts this year, and therefore it's likely repricing. That is not a bad thing, okay? That is absolutely not a bad thing. It makes sense. The high beta stuff is getting sold, and you've seen the reaction to the earnings, Netflix, the Taiwan Semiconductor, and so on. Very good earnings, but the market sells off. And that is likely to continue. And next week we have Microsoft, we have Google, and that is the fear in the NQ. So NQ is going to have by far the highest volatility. And this is the sector that I think can make the furthest lows. So the Dow has already probably done 80% of what it's going to do. The S&P has probably done 70% of what it's going to do to the downside, I mean. But probably NQ has done the least. I think NQ could easily trade in this 16,600, 16,400 area next week and then bounce like a bitch, because it always does. Now, to me, it just makes sense that what you do is you watch the Dow. And if the Dow is stable, the only thing you can sell is the NQ. So every time the Dow actually starts going up, it's going to influence S&Ps some, but it's not going to influence NQ at all. And you saw how it traded on Friday. On Friday, the Dow was up all day, every day, and making new highs, and the NQ was making new lows, and the S&P could do nothing but go down with the NQ because it's cap weighted the way it is. That to me indicates that if you want to get a timing for, in fact, you don't, that to me indicates that you don't really need a timing for anything. You just need to buy options, and you want to be buying puts on the NQ every time it rallies, and you want to be buying calls on the Dow every time it dips. The European markets are actually trading very, very well indeed relative to what is happening and the other markets. My buy level here is going to be in this area. And don't forget that I told you that I don't think we've seen the lows. I think that we're going to have very violent swings, but we will see the new lows and then you buy them. To me, this kind of area, 4,700 to 4,666, is going to be a wonderful buy area. Maybe there's going to be an ABC. I'm convinced we're going to see new lows from the lows that we made last week in the course of the next couple of weeks, probably before QRA. But then what you do is you buy them. The risk reward of buying calls here is absolutely fantastic. So let's have a look at volatility, because that's going to be important. And I still think that realized is going to be higher than implied over the course of the next few weeks. And we could easily see something like this, i.e. ramp up, we touch the 22 and then come down. So that's, don't forget that, it might take several days of attempts up here and then finally back down towards the 16 area. Saying is, I don't think we've seen the low. I don't think we've seen the high in the vol. I think that it will be violent swings, and I think you will probably see this 17 area just below it, and you'll also see the 22 area. It's going to be a violent couple of weeks in terms of vol swings and realized swings even more. I've updated the levels, and really the message is avoid the belly of the curve as much as you possibly can. I don't think in terms of yield is going to go very far, but what it is going to do is be the weakest part of the curve. We do have the QRA and the FOMC the week after next. So this week, really the net change in pricing, I don't think is going to be that great, because A, we don't have that much data. That is all that important, but the market will want to be in a pretty neutral position ahead of FOMC and QRA. But that to me will be the weakest part of the curve. I think SPX is going to have a violent week up and down on the back of NQ, which is definitely going to be the most volatile. I don't think we've seen the lows in either, but at some stage it becomes a great buy. From now on, for next week, everything you do is in options because, as I said, realized volatility should be higher than implied. Thank you very much indeed, and tweet you tomorrow.